The Bank of Canada this morning lowering the overnight rate by a quarter point. Tiff Macklem, the governor of the Bank of Canada, defending his position on lowering the overnight rate by a quarter point, citing weak economic data. Food, fuel, and housing prices have risen dramatically, much faster than wage growth in this country. The economy is suffering, and Tiff Macklem and the Bank of Canada are late to the party. Although not directly correlated to mortgage rates, the overnight rate is a great measuring stick of the monetary policy in Canada. When the overnight rate is set lower by the Bank of Canada, they're trying to stimulate the economy by putting more reserves in commercial banks. These commercial banks can then lend out more money and stimulate spending. When the Bank of Canada tightens monetary policy, that means that they're raising the overnight rate, preventing commercial banks from lending more money. Fixed rate mortgages are more tied to long-term bond rates and do not have a direct correlation to mortgage rates. However, borrowers with variable rate loans, such as lines of credit or variable rate mortgages, will be somewhat relieved by this drop in the overnight rate. Now, one major problem in Canada that the Bank of Canada itself has been talking about since October 2023 are negative or non-amortizing mortgages. So what is a non-amortizing mortgage? It's where your payments have been fixed, but the interest rate is variable, which means a non-amortizing mortgage is never getting paid off. In fact, your payments may even be lower than the interest cost alone. And since the Bank of Canada in the last several years has taken a very aggressive stance at raising these rates over the last few years in order to combat inflation, variable rate and line of credit borrowers have been suffering. So you may now be at a point where your mortgage payment doesn't even cover the interest, so you're simply not even amortizing the mortgage anymore. You're never paying it off. Now, as of data available from the commercial banks that was released in June, the Canadian main 8 lenders had a total of $1.6 trillion of mortgages outstanding. 37%, or $613 billion of those mortgages have amortization schedules of longer than 25 years. And out of that total, $213 billion of those mortgages have a remaining amortization of longer than 35 years, and $92 billion are negatively amortized, which means these people are not making enough payments to satisfy the interest cost of these mortgages, as they have dramatically risen over the last few years. Now, what can you do to avoid the trap of a negatively amortized mortgage or a non-amortizing mortgage? Well, today's Bank of Canada announcement may provide some relief, but probably not enough. We are expecting further rate cuts over the next several months from the Bank of Canada, but it will be too little too late for some borrowers, unfortunately, as these rate cuts will probably only be 0.25% at a time. In the interim, don't be afraid to rein in your spending, and if necessary, it's time to rethink your thinking. You may be forced to make hard decisions, such as completely gutting your expenses, or maybe even considering downsizing your home. The question I believe you have to ask yourself is, how much of your income are you willing to perpetually give to your bank over the long term? And I would also caution you to think that if the Bank of Canada cannot accurately predict the economy or where interest rates are going over the short or long term, what makes you think any banker possesses any greater knowledge than the Bank of Canada themselves? Or it makes us think that we can out-predict what interest rates are going, or where interest rates are going at all. Now, for those of you who are watching this video who have a fixed rate mortgage, get prepared in the next couple of years. We don't know what the Bank of Canada is going to do, but there is a good chance that you are going to face an interest rate risk, the risk of reset at a much higher rate than what you locked in when you originally signed your mortgage a few years ago. Again, although we can make some educated decisions, trying to predict what the Bank of Canada monetary policy decisions is a basic impossibility. Maybe you're watching this video and have a great budget and you aren't concerned with where interest rates are going short or long term. Or maybe you have lots of investments or savings that you're not concerned about what the Bank of Canada is doing. You're more concerned about where the Bank of Canada is going on the investment side, and your interest rates that you're earning on your term deposits or GICs is starting to fall again. Whatever the case and whatever your personal financial situation is, we should always default to saving as much money as possible in a tax-exempt or tax-free environment. Perhaps you're in a tax-free environment by filling up your TFSA, or maybe you're thinking about a tax-exempt environment by using a properly designed tax-exempt life insurance contract to store your capital. Listen, it doesn't make sense. If you've paid tax on your money once, why would you take your hard-earned money and continue to pay tax upon tax upon tax? Pay tax once on your money. Don't pay it 2 or 3 times. The foundation of tax law in Canada allows Canadians to arrange their affairs in the most tax-efficient manner. So why not take advantage of that? For more financial planning tips, information on how to put your money in a tax-exempt environment, check us out at IBCanadagroup.com. Book a meeting with one of our advisors and find out how you can grow, control, and protect more of your wealth.